There's a number sitting on the XRP Ledger right now that should not mathematically exist. And the strangest part is that almost nobody in the retail crowd is looking at it. They're staring at the price chart. They're staring at the next ETF headline. They're staring at whatever Garlinghouse posted on X this morning. And while they're staring at all of that, a quiet equation is solving itself in the background. An equation that, once you actually run the numbers, makes the current price of XRP look less like a market valuation and more like a temporary clerical error. I'm not going to give you a price prediction today. I'm not going to give you hopium. I'm going to give you a math problem. And by the time we finish solving it together, you're going to understand why the people who built this system have been telling you exactly what's coming for years, and why almost nobody has bothered to do the arithmetic. Let's pull back the curtain. Welcome back to the channel. No hype, no shilling, no manufactured urgency. Just the data, the structure, and the discipline to follow them wherever they lead. Today we decode what I'm calling the XRP supply equation. 5 overlapping forces that are quietly, mathematically, and irreversibly redrawing the scarcity profile of this asset. Before we go under the surface, understand this is analysis, not financial advice. In this briefing, we examine why the most bullish development in XRP's history isn't a partnership, isn't an ETF, and isn't a court ruling. It's an equation, and it's already being solved. Let's jump in. Let's start with the hard truth. Roughly 95% of retail XRP holders are staring at the wrong number. They see 100 billion. Max supply, fixed, capped. And they conclude, almost reflexively, that scarcity is impossible. There's just too much of it. Case closed. Move on to the next chart. But here's what they're not doing. They're not asking the second question. They're not asking how much of that 100 billion is actually available to be bought right now, today, on the open market by someone with a wallet and an order book. Because the moment you ask that question, the entire narrative inverts. To understand what's happening, you need to understand a concept that institutional desks understand instinctively, but retail almost never thinks about. It's called functional supply. Functional supply is not the same as max supply. It's not even the same as circulating supply. Functional supply is the amount of an asset that is genuinely, immediately, frictionlessly available to a buyer at the current price. Everything else, escrow, custody locks, ETF reserves, treasury holdings, lost wallets, dormant addresses, that's all theoretical supply. It exists on paper, it doesn't exist on the order book. And here's where it gets uncomfortable for the 100 billion is too much crowd. The functional supply of XRP is shrinking. Not slowly, not theoretically, measurably. Right now. And it's shrinking across 5 separate channels, simultaneously, which is something that has never happened before in this asset's history. You see, retail investors look at the order book and assume that's the whole market. But financial institutions, the ones with custody desks and prime brokerage relationships and tokenization infrastructure, they don't operate at the order book. They operate underneath it. They move size through OTC desks. They lock supply in custody before it ever touches an exchange. They build positions that retail will never see on a Glassnode dashboard until it's far too late. This is the part of the equation that David Schwartz has hinted at for years without ever spelling it out. This is what Brad Garlinghouse means when he says the institutional era has begun, past tense, not is coming. The architecture is already live. The pipes are already flowing. The supply is already being drained from the bathtub, while retail is still arguing about whether the faucet is even on. Let me give you the foundational number that frames everything else. Circulating supply right now sits at approximately 62 billion XRP. Not 100 billion, 62 billion. The other 38 billion sits in Ripple's escrow, released in monthly tranches, and the overwhelming majority of those tranches get re-escrowed. So when we talk about supply available to the market, we're talking about 62 billion. That's the actual denominator in the equation we're about to solve. And 62 billion, mapped against what's coming, is a remarkably small number. Let's do the math. Because this is where the thesis stops being a thesis and starts being arithmetic. There are approximately 7.4 million active XRP wallets in existence today. If every one of those wallets accumulated just 8,400 XRP, the entire circulating supply would be absorbed. Every unit, gone from the open market. Now, 8,400 XRP at current prices is a position size that a mid-tier retail investor could build over a few months of consistent buying. It is not an institutional position. It is not a whale position. It's a determined retail position. Now let's scale that against where wallet growth is actually heading. Conservative projections based on Ripple's institutional rollout, RLUSD adoption, and tokenization onboarding put active wallet count at 15 to 20 million by 2028. Take the midpoint, 17 million wallets. Divide 62 billion circulating supply by 17 million wallets. You get roughly 3,650 XRP per wallet to fully absorb the available supply. That's it. Less than 4,000 units per wallet, and the order book is structurally empty. But that's just the retail layer. That's the easy part of the equation. Now layer in the institutional pool. Standard Chartered has projected $4 trillion in tokenized real-world assets by 2028. Ripple's own internal projection extends that to $19 trillion by 2033. Now here's the brutal question retail isn't asking. What is the settlement layer for those tokenized assets? The answer increasingly is the XRP Ledger. And every tokenized transaction on that ledger requires XRP, not as collateral, not as backing, as the actual bridge asset that moves value across the rails. Run the numbers on what that means for functional supply. If even 0.5%, half of 1%, of that $4 trillion tokenization wave routes through XRP as a settlement bridge with a 24-hour average holding period, you're looking at roughly $20 billion in XRP that has to be locked in active settlement at any given moment. At current prices, that's a meaningful percentage of the entire circulating supply just sitting in transit. Not held, not owned, in transit, constantly. Now layer the ETF channel on top of that. Spot XRP ETFs have already absorbed close to 1% of total supply, and we are nowhere near peak ETF demand. Bitcoin ETFs absorbed roughly 5% of BTC supply within their first 18 months. Apply that same trajectory to XRP, and you're looking at another 3 to 5 billion XRP migrating into ETF custody over the next 24 months. That's supply that does not come back to the order book. ETF shares can trade. The underlying XRP does not. Now add the treasury company layer. We are watching the early formation of corporate XRP treasuries, the same pattern that emerged with Bitcoin treasury companies between 2020 and 2023. MicroStrategy alone absorbed nearly 1% of Bitcoin's circulating supply. If even 3 or 4 meaningful XRP treasury companies emerge over the next 18 months, that's potentially another 1 to 2 billion XRP removed from circulation indefinitely. Now add the ledger reserve layer. Every active wallet on the XRP ledger requires a small base reserve. Insignificant per wallet, significant across millions of wallets. As the network onboards institutional accounts, sub-accounts, tokenization vaults, and liquidity pools, this reserve drain compounds. And finally, the burn mechanism. Every transaction burns a small amount of XRP. At current volumes, this is a rounding error, but the burn rate scales with transaction volume. And transaction volume scales with tokenization adoption. By 2028, if the XRP ledger is processing even a fraction of the projected tokenization volume, the daily burn becomes a structurally meaningful deflationary force. Add it all up. ETF absorption, institutional DeFi lockup, treasury accumulation, ledger reserves, transaction burn, 5 forces, all pulling in the same direction, all accelerating simultaneously. And the supply, the actual functional supply available to the open market, is mathematically shrinking even before you account for natural retail accumulation. This isn't a prediction. This is the logical mathematical outcome of the infrastructure that has already been built and deployed. If you have a problem with these numbers, you don't have a problem with me. You have a problem with arithmetic. While retail investors are panic selling on red candles and complaining about price action, the institutional signal has never been louder. And the signal isn't coming from press releases. It's coming from infrastructure deployment, which is far more important. Look at what Ripple has actually built. Ripple Custody. Live, operational, designed specifically for institutional players who need compliant, segregated XRP custody before they can deploy capital at scale. Ask yourself this brutal question. Why does a company build institutional custody infrastructure unless it is expecting institutional demand? You don't. That's not how product roadmaps work. Custody is the last thing you build before the floodgates open, not the first. Then look at Hidden Road, the prime brokerage Ripple acquired. 300 institutional clients, approximately $3 trillion in cleared volume annually, post-trade settlement migrating onto the XRP Ledger. That's not a partnership announcement. That's a pipeline. That's the plumbing through which institutional flow will physically move. Then look at RLUSD integrated with G-Treasury. G-Treasury connects to roughly 13,000 banks and processes around $12.5 trillion in payment volume. Read that number twice. $12.5 trillion. And XRP sits as the bridge asset underneath that infrastructure stack. Then look at who already holds XRP exposure on the institutional side. Goldman Sachs, Grayscale, major Wall Street custodians. These are not firms that take speculative positions. These are firms with compliance departments, risk committees, and research desks whose entire job is to evaluate long-term viability before a single dollar of client capital moves. When those names appear in disclosure filings, that's not noise. That's the result of a multi-year due diligence process, concluding positively. Ask yourself, does a firm like Goldman Sachs move without legal certainty? Absolutely not. They don't gamble. They position, and they position quietly, through ETFs, through custody arrangements, through structured products, in a way that absorbs supply without ever showing up as a headline. This is the part of the picture retail consistently misses. When an institution builds a position, that position doesn't come back to the order book the way retail positions do. Retail buys XRP and might sell it next month for a 15% profit. An institution that locks XRP into a structured product, an ETF basket, or a tokenization vault has that supply removed from market velocity for years, sometimes indefinitely. The supply is moving from weak hands to iron hands, from impatient sellers to long-term architects, from the open market to locked positions. And the market price hasn't adjusted yet because the absorption is happening underneath the order book, in the shadow liquidity layer that retail can't see in real time. This is the institutional era beginning, not the announcement of it, the execution of it. Now let's talk about timing, because the equation has a clock attached to it, and that clock is accelerating. We are less than 2 years from the 2028 inflection window that Standard Chartered's tokenization projection points to. That's not a vague, someday target. That's a window that institutional roadmaps are actively building toward. And the closer we get to that window, the more aggressively the supply absorption channels activate. Specifically, watch 4 catalyst layers over the next 18 to 24 months. First, the regulatory layer. The digital asset market clarity framework that's been working through Washington removes the final risk premium that has kept some of the largest institutional pools sitting on the sidelines. Once that classification clarity is in place, the wait-and-see capital becomes deploy now capital. And that capital doesn't trickle in. It floods in because institutional allocators move in size. Second, the ETF expansion layer. We are still in the early innings of spot XRP ETF adoption. As more issuers launch products, and as access expands across retirement accounts and wealth management platforms, the ETF absorption rate compounds. This is the channel that quietly removed millions of Bitcoin from circulation, and the same mechanism is now active for XRP. Third, the tokenization activation layer. As more real-world asset tokenization projects go live on the XRP Ledger, and we're seeing this acceleration in real time through partnerships with Archax, securitized adjacent infrastructure, and sovereign-level pilots, XRP demand transitions from speculative to functional. Functional demand is structurally different from speculative demand because it doesn't go away when sentiment turns. It scales with usage. Fourth, the corporate treasury layer. We are watching the first credible XRP treasury company formations right now. This is the same pattern that began with Bitcoin in 2020. Once 2 or 3 high-profile treasury announcements occur, the FOMO effect on other corporate balance sheets accelerates the pattern. When all 4 of those catalysts hit critical mass simultaneously, and the trajectory suggests they will in roughly the same window, the supply absorption rate goes vertical, and the price reflection follows. The window is closing. Not because of hype, because of math. We are moving from an era of XRP abundance to an era of XRP scarcity. And most people are going to realize this only after the transition is complete. Think about what happens when functional supply contracts faster than demand grows. The order book thins, bid-ask spreads widen. Each incremental dollar of buying pressure moves the price more than it would have in a liquid market. This is exactly the dynamic that drove Bitcoin from $3,200 to $68,000 between 2018 and 2021. Not a single event, but a sustained structural contraction of available supply meeting expanding institutional demand. The same architecture is now in place for XRP. The mechanisms differ: burn instead of halving, institutional DeFi instead of just spot ETFs. But the underlying dynamic is identical. Supply gets absorbed across multiple parallel channels. Circulating supply shrinks. Demand grows. And at some point, the math forces a price adjustment. Here's the part that should make every patient holder pay attention. Once XRP enters an institutional custody vault, an ETF basket, a treasury company balance sheet, or a tokenization settlement reserve, it does not come back to the open market for a quick flip. It is gone. Locked. Structurally removed from the float. The institutions are not trading in and out of these positions. They are accumulating them as core holdings for the next decade of digital finance infrastructure. And this is where the priced-out risk becomes real for retail. Right now, anyone with a few $100s can accumulate a meaningful XRP position in whole units. But as functional supply contracts and as institutional absorption accelerates, the window during which retail can build a whole unit position narrows. At some point, the math no longer permits it. Retail starts thinking in fractions, in drops. The unit psychology shifts, and the people who hesitated during the boring sideways months are the ones who realize, only in hindsight, that the accumulation phase was the entire opportunity. The institutions have spent years quietly building the infrastructure that will absorb this supply. They have been patient. They have been disciplined. They have not chased price. They have positioned. And the people who pay attention to what they're building, rather than what the chart is doing today, are the ones who end up on the right side of the equation. The door is closing. Not loudly, quietly, mathematically. I know it's tough to watch the chart move sideways. I know the headlines create doubt. I know the cycle of, "this is finally the breakout," followed by another retracement, is exhausting. As an analyst, I'm trained to distinguish between noise and signal. And let me tell you what the signal actually is. The signal is not the price. The signal is the infrastructure deployment rate. The signal is the institutional custody activations. The signal is the ETF inflow consistency. The signal is the tokenization pilot announcements. The signal is the slow, methodical, deliberate construction of the financial plumbing that XRP was designed to settle. While the masses focus on the daily candle, the smart money is focused on the design specification. And the design specification has not changed. If anything, it has accelerated. The custody is live. The prime brokerage is operational. The stablecoin is integrated with global banking infrastructure. The tokenization rails are live. The ETFs are absorbing supply. The treasury companies are forming. Every single piece of the architecture that was theorized 3 years ago is now operational. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality, in this case, is governed by arithmetic. The arithmetic doesn't care about your impatience. It doesn't care about the daily candle. It doesn't care about the influencer who said XRP would be at $10 by last Christmas. It only cares about supply, demand, and the rate at which they diverge. The question isn't whether the price adjusts. The question is who is still holding when the adjustment happens. The question is who did the math when the room was quiet, and who waited for the noise to confirm what the data already said. Let me bring this back to where we started. The most bullish thing happening to XRP right now is not a partnership. It is not a court ruling. It is not an ETF approval. It is an equation. A 5-channel supply absorption equation that is being solved in real time, quietly, mathematically, and irreversibly, while most of the market is staring at the wrong variables. ETFs absorbing supply into custody. Institutional DeFi pulling XRP into liquidity pools. Treasury companies building long-term positions. Ledger reserves expanding with network adoption. A burn mechanism that scales with transaction volume. 5 forces. One direction, one outcome. 100 billion is the number retail points to as proof that scarcity is impossible. But functional supply, the only number that actually matters for price discovery, is shrinking. And by the time the broader market notices, the accumulation window will already be behind us. Price is a distraction, structure is the reality. And the structure is finishing its assembly. If you made it to the end of this video, drop the word equation in the comments. I want to see who actually thinks in terms of math and structure instead of candles and hopium. If you value this kind of deep dive analysis, you know what to do. Stay patient, stay analytical. The math doesn't lie, and the system is almost complete. I'll see you in the next one.